to demand repayment.
It's fascinating, right?
It really is, yeah.
We'll see ultimately what it's worth once they get a better feel. But if it's got a $20 million loan, like you wonder, how much is that? Is that 10%, 20%?
I want to know how much this super yacht sets you back.
I don't know. Yeah, that's
we'll find out.
A little rich for my taste. All right, you're listening to Bloomberg Business Week. Carol Massar, Tim Stanovic, and you are listening to Bloomberg Radio. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 43 minutes to go ahead of the closing bell. U.S. stocks trading little changed on this CPI Wednesday, right to the numbers, with the S&P up now by 3 points, up 0.1%. The Dow down 66, drop there of 0.2%. NASDAQ higher by 33, a gain of 0.3%. 10-year yield 2.90%. The 2-year is at 3.14%. Spot gold up 0.5%, $17.34 the ounce. West Texas Intermediate crude up 0.6%, 96.41 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So in 2021, Saks Fifth Avenue spun off its digital business, that e-commerce business now known as Saks, and is headed up by our next guest.
Mark Metrick is CEO of Saks. Mark joins us on Zoom from New York City. Mark, good to have you with us. How are you?
I'm great. How are you guys?
We're doing well. Hey, we're thinking a lot about inflation, about the macroeconomic environment right now.
Nothing you ever think about, right?
Nothing you ever think about. So really eager to get your thoughts on the state of the American consumer right now. We got this hotter than expected inflation number, the highest in more than 40 years. How is your consumer doing at Saks?
Yeah, I think that I want to just focus on the luxury consumer. And as you guys mentioned, we were out in the field with research and two things. We're seeing in the response of our business, we feel very good about the core luxury consumer, just both from how they're showing up and how they're shopping. And also they've indicated, 75% of respondents to the survey that I would categorize in that core luxury consumer said that they would spend the same, if not more, over the next 3 months than the prior 3 months.
You're talking about people, just so we can have these definitions for our audience, these are people who have an income of $200,000 per year plus?
Yes.
Okay, so like a household income or an individual?
A household.
Okay.
And are they younger, older? What are they? I love knowing the demos when it comes to retail.
Well, it's about stage, not age. These are people that are luxury consumers. They love fashion. They're aspirational. They're core. So they're a bit all over. But if you really want to dig down and look at it, you're actually seeing a little bit on the response side more positivity, and it's probably from a recency bias because the younger consumer hasn't seen one of these moments before. They're feeling a little bit more bullish than the boomers or the silent. So interesting, but again, the overall response has been positive on what they're thinking from a luxury standpoint.
So from a luxury standpoint, are they buying luxury clothes, luxury stuff for the house, luxury, cosmetics? Like what specifically? Luxury can cover a lot.
Yeah, so for us, it's about accessories and apparel. Okay, that's where we center. Now they're still looking at home and other types of luxury products inside of their lifestyle, but the core business for us is around that apparel and accessories and leather goods.
What kind of luxury apparel? Like, have people moved away from all of the comfy wear? And listen, I love a great pair of yoga pants. They're not inexpensive, so I consider that kind of luxury as well. But are people trading up? They're going out, they're going to places, and so you can see that reflected in what they're buying.
Absolutely, and what we're seeing, and a great indicator of that is sneakers it's like you almost only wore sneakers for a while, and now we're seeing shoes make a big comeback, and that's been good. Guys are getting dressed up again. She's getting dressed up. It's a dressy sandal. It's not just a sandal. It's a shoe. It's not a sneaker. There's a lot of heel coming back. Platform heels are going to be one of our biggest trends as we come into the next couple months. So it is about getting dressed. It is about going out. It's about traveling, and it's good for business.
Can I just say, I love me some platforms, but Jim, I'm just going to put that out there.
Okay, I got nothing to follow up on that, Carol. I do want to know, Mark, though. I want to know about how spending has shifted, because if I think about what we've been talking about for the past 2+ years, the idea that people filled their homes with stuff and then it got stuck on ships, so they couldn't do that. Then they started buying things as they got back to the office, but now it seems like demand for vacations and experiences is back. This idea of stuff we were talking about back in 2019, especially when it comes to millennials spending their money on not on stuff, but on doing things. How did that factor into your research?
Yeah, so the research came back, and look, when asked, respondents number one on their list is travel and leisure. And that's fine, because with luxury and again, being a GOAT, so being that go out and travel, I'm glad for you to take a vacation. Because you're going to buy a lot of stuff to wear on that vacation. I'm glad that you're going back to the theater. I'm glad that you're meeting friends and going to weddings. This is all good for Saks and for luxury, so that's okay. But right on the heels of that response, again, was leather goods and accessories. We're right there behind that for this, high-end luxury consumer on where they and how they want to be spending.
Mark, help me out here because, when we talk retail and the consumer world, we constantly talk about, and we often have heads of companies talk to us about this seamless omni-channel experience. So you guys are focusing on e-commerce. How do you guys do it? How do you make sure that you're covering how the consumer wants to shop?
Yeah, and we do focus on e-commerce, but we focus on the consumer. And that's really, what we've done with the split is just enabled my company to focus on the digital experience, but it's focusing on the brand experience, first and foremost. We haven't stopped with the omni-channel connected experience for our consumer. Our exclusive partnership with the SFA stores enables us to execute this all-channel experience seamlessly. You can, 40% of the returns that came in from Saks.com went into the stores just this past quarter. So you can buy online, it can ship from a store. You can do almost anything. You could buy online, have it altered in the store. We haven't stopped that. So what we've done is really just given ourselves the ability to build two strategies, but those two strategies connect through the consumer, which makes omni-channel still a big and important part of the Saks ecosystem.
Mark, just in the last 30 seconds we have with you, give us an update on the supply chain and give us an idea of if you're able to stock shelves, if you're able to actually get consumers what they want.
Yeah, the luxury supply chain, probably on a relative basis hasn't been interrupted. I'm sure it's a little bit slower than people want it to be, but comparatively to what we'll be hearing, we haven't had any issue with that.
What's the last thing you bought in a retail environment?
You're asking me?
Yeah.
I just bought a suit. How's that?
Okay.
All right, back to work you go.
That sounds, yeah.
Absolutely.
That isn't like athleisure or workout.
Wait, but is that for Mark for hanging out or for working?
To be fair, it's a suit, but it's got drawstring pants.
Oh, athleisure. I like it.
That's right. So guys, just remember, fashion has, it doesn't matter. It's all about comfort. It's all about looking good.
I'm all into comfort. Put a little stretch in everything. Mark Metrick, thank you so much, CEO at Saks, joining us via Zoom in New York City. You're listening to Bloomberg Business Week on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, so today was all about the inflation print. Tomorrow's going to be about
the banks, the big banks, and also we got other financial services companies reporting over the next few days too.
Yeah, we'll get an idea of loans, consumers, businesses, the health of it all. So we're looking forward to that. Our next guest is going to address that.
Yeah, we're going to talk to Cheryl Pate at Angel Oak Capital. First, though, I want to get a check of the trading day. Here's Charlie Pellet.
And we're just slipping into the red, Tim. J.P. Morgan Chase, by the way, tomorrow morning, bright and early, down now by 1%. And, of course, more on the banks coming up in just a moment. Right to the numbers, because we are in the red across the board now. The Dow down 164, down 0.5. S&P down 11, drop there of 0.3%. NASDAQ now trading lower, giving up earlier gains, down 6 points now, a drop there of 0.1%. CPI Wednesday, 10-year yield 2.91%. The 2-year yield 3.13%. How's that inverted yield curve going to play out with the banks? Spot gold up 0.4%, 17.33 the ounce, while West Texas Intermediate crude is up 0.2%, 95.99 right now for a barrel of West Texas Intermediate crude. Stocks whipsawed as a shockingly hot inflation report this morning rattled financial markets, boosting bets that the Fed could get even more aggressive with its belt-tightening campaign. The question now is just how big might those cuts be in the future? Lindsay Piegza is chief economist at Stifel Nicholas.
If we continue to see these elevated levels of prices, given the Fed has told us that the prerequisite for a more benign pathway is a marked decline in headline inflation, it's hard to imagine that they take a softer stance or begin to back away from additional 75 basis point increases as we move closer to the fourth quarter.
Spirit Airlines has agreed to delay a planned shareholder vote yet again on a proposed acquisition by Frontier Group Holdings, giving more time to build support for a deal that has failed to overcome a higher bid from JetBlue Airways. Right now, we have got airline stocks in general, for the most part, trading lower. JetBlue is down now by 2.3%. Frontier higher by 0.1%. Spirit up by 0.7%. Recapping, S&P down 11, drop there of 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I don't know if you saw, Tim, some comments from J.P. Morgan Chase's CEO, Jamie Dimon, saying the Fed's forecast for 4% inflation this year is, quote, too optimistic.
I thought you were going to give me a weather report. I did not see this.
It was an interview published in the Wednesday edition of a French newspaper. So we're going to hear more from, safe to say, what is the most closely watched big U.S. bank CEO when J.P. Morgan reports tomorrow morning.
All right, for a little preview of what to expect, not just from J.P. Morgan, but from other financial institutions, let's go now to Cheryl Pate, Senior Portfolio Manager at Angel Oak Capital. Cheryl joining us this afternoon on the phone from Atlanta. Cheryl, if there's one question that you would ask Jamie Dimon, what would it be?
I think really the key question on everyone's mind is, how do we manage through the uncertainty over the next couple of quarters? Clearly, with the inflation print this morning, raises additional questions on, do we fold over into a recession here? And what is the outlook, particularly for the consumer against this backdrop?
Well, okay. So what do you think ultimately? Okay, so let's go through big bank earnings in terms of what you're expecting to see. We've already had a story out on the Bloomberg that talked about trading, because of all the volatility, should be a plus for the big banks when they report.
I do agree with that. I think we are going to see strong trading results. I do think the big money center banks are going to be challenged by softer investment banking, as well as potential marks on widening credit spreads, higher expenses as well. So I think, the more diversified business models are going to have a tougher time this earnings season, given, some of the factors impacting investment banking, asset management businesses, mortgage banking, and the like.
What about, though, when it comes to other parts of the company's business, trading revenue, that, as we talked about yesterday on the program, volatility is a good thing?
Volatility absolutely is a great thing. And we do have a positive outlook, not only for the equity capital markets, but even more so for fixed income capital markets. And that is where we expect a bright spot in capital markets tomorrow, kicking off with JP Morgan. So we should see some positive trajectory there. Again, I think that is going to be offset by the investment banking advisory type fees, which are probably down close to 50%.
Yeah, we're not talking about a lot of IPOs these days,
No.
or M&A.
No,
Not at all.
absolutely not.
Hey, how often how much do you expect them and the CEOs and the C-suite on those earnings calls, Cheryl, to talk about recession? I mean, you said, how do we manage through the uncertainty of the next few months? How far do you think they go in saying, listen, we're going for we're going to see a downturn? Do you anticipate that we're going to hear that?
I do think we are going to hear heightened caution from management teams. Clearly, from what we can see in terms of credit metrics that come out on a monthly basis, that remains relatively benign. You're not expecting to see any meaningful reserve build this quarter, but clearly, what we're seeing today is sort of 6 months forward. We're looking sort of a year, 2 years forward in terms of valuing stocks. And so I think that's going to become more critical. Where are we starting to see potentially any signs of stress? I do, think that's going to be one of the key topics of conversation, particularly on the consumer side, the unsecured consumer, the credit card businesses.
Let's get to some of the names you like, because you actually like some more of the regional players. And one that really pops up on my radar, the ticker is SIVB. You're talking about SVB Financial Group. I caught up with Greg Becker on a panel over at Milken. I mean, they do it a little bit differently.
Yeah, that's right. I think, generally the way we think about the banking universe, our overweight is to the spread-based lenders. I think quality is king here. Deposit franchises matter. Loan growth matters. And that's where we really see the value in the regional banks over the universal banks in this type of environment. And someone like an SIVB clearly has a demonstrated track record of growing that, not only the loan side, but also the deposit side, which I think is going to be increasingly critical and really a focus of investors going forward as to where deposit betas go from here.
Very quickly, just in the last 30 seconds we have with you, let's talk about Signature Bank. Why are you bullish on that one?
Again, I think it comes down to someone that has done a great job on gathering deposits over the last couple of years, outsized growth relative to peer group, sticky deposits. Again, when we're looking to higher rates from here, the NIM expansion, I think, is hitting sort of the peak over the next second quarter, third quarter type time frame. And that's really, I think, what's going to drive outsized performance from someone like a Signature Bank.
And both of them have really been beaten up big time by investors. Signature is down about 41% so far this year, and SVB Financial, Silicon Valley Bank, that's the holding company for that bank, it is down about 40% so far this year. Cheryl, thank you so much. Great setup for those bank results as they start to roll out. Cheryl Pate, she's Senior Portfolio Manager at Angel Oak Capital, on the phone from Atlanta.
Let's go from Atlanta to D.C. for an update on world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. The Consumer Price Index in June rose 9.1% from a year earlier. That is the highest it's been since late 1981. And Senate Minority Leader Mitch McConnell believes it shows Democrats are failing when it comes to fiscal policy.
This morning, this all-Democratic government produced yet another absolutely terrible inflation report.
McConnell says Democrats have not taken inflation seriously. President Biden has weighed in on the report while on his Middle East trip and says the CPI index is outdated since gas prices have dropped more than 40 cents a gallon in the past few weeks. Democrats are pointing out the dangers of the Supreme Court's recent decision to overturn Roe v. Wade. While opening a hearing today on Capitol Hill, Washington Senator Patty Murray said the ruling has prompted a health care crisis involving women's reproductive rights.
They overturned Roe v. Wade, ended the right to abortion, and upended the lives of millions of people. And the consequences have been harsh and swift.
Again, Democratic Senator Patty Murray. Meanwhile, Kansas Republican Senator Roger Marshall accuses Democrats of promoting fear-mongering that's not based on facts and says the ruling, quote, signals a new beginning for millions of unborn American babies. Some Democratic-controlled cities in Republican-led states are looking for workarounds on abortion bans. The Washington Post reports more than 50 district attorneys have signed a pledge not to prosecute cases involving abortions. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. Something we wanted to bring to you, it's certainly been featured high on the Bloomberg, and it's certainly something you hear about a lot overnight when we get all the news out of Asia and China specifically. And this has to do with what we're seeing across China. Home buyers there are refusing to pay mortgages as property developers drag on construction projects, escalating the country's real estate crisis and risks of bad debt for banks.
Yeah, check this out, Carol. Buyers of 35 projects across 22 cities have decided to stop paying mortgages as of July 12th. This is due to project delays and a drop in real estate prices. This, according to analysts at Citigroup, led by Griffith Chan. They wrote this in a research report that was distributed today.
So what's important about this is those payment refusals underscoring how the storm engulfing China's property sector now affecting the country's middle class, posing a threat to social stability. And this is something we know the government keeps an eye on, right? They certainly don't want any kind of upheavals. Chinese banks already grappling with challenges from liquidity stress among developers now also have to brace for home buyer defaults. You know, on a number basis, we're not talking about, the contagion that's spreading to banks, non-performing loans triggered by the wave of mortgage payment snubs should reach as much as about 83 billion US. That's about 1.4% of the outstanding mortgage balance. Yeah, but said to be manageable for the banks.
Exactly.
Maybe not for all of them, but certainly it seems like overall.
Yeah, these state lenders include China Construction Bank Corp, Postal Savings Bank of China, and Industrial and Commercial Bank of China. They may have more exposure to mortgages and could suffer setbacks amid dampened investor sentiment. This according to the note from Chan and his team.
I just think, when we keep an eye on the global economy and we look at what's going on in Europe in terms of the pressure, that they're seeing because of higher energy prices, because of that war in Ukraine and other factors, what's going on here in the U.S., but to keep an eye on what is the second largest and second biggest and most important economy globally, and we're talking about China. So just different stories that come out that make me wonder about what's the outlook for China specifically, and what drag that might have on the overall global economy.
And look, that's why we're going to eagerly await earnings from these companies that are going to tell us how things are going in China.
Yeah, and watching economic data points out of there as well. You're listening to Bloomberg Radio.
results, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Atlanta Fed President Raphael Bostic says, quote, everything is in play. Federal Reserve officials may debate a historic 1 percentage point hike later this month after another searing inflation report this morning piled pressure on the central bank to act. Stocks are heading lower as we move towards the closing bell. We've got the S&P down by 13 now. That is a drop of 0.4%. Dow Industrials down 183, a decline right now of 0.6%. NASDAQ is down 10, a drop there of just about 0.1%. The 10-year yield, 2.90%. The 2-year yield, 3.12% as the yield curve remains inverted. Spot gold up $7 the ounce to $17.33, a gain of 0.5%. West Texas Intermediate crude up 0.1%, $95.91 a barrel. So again, CPI Wednesday, stocks lower, S&P down 14, a drop now of 0.4%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. In some ways, Congress's response to the COVID-19 pandemic amounted to a striking bipartisan success. Lawmakers passed 6 laws offering more than $5 trillion in relief, helping to keep households afloat, businesses open, and the economy from outright collapse. Unfortunately, the response also wasted money on a large scale. An analysis of more than 11 million Paycheck Protection Program loans found that about 1.4 million, or fully 12%, showed some indication of fraud. The authors estimate total suspicious lending may have exceeded $117 billion. Any big federal outlay will lead to attempted scams and swindles, yet the scale of COVID fraud has been remarkable. Congress owes it to taxpayers to find out what went wrong and to recoup as much of their money as it can. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg Terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, 10.5 minutes left in today's trading session. Getting ready to wrap up the Wednesday trade. We're definitely off our lows of the session, so not as negative as it was earlier in the day right after that inflation print, but still, we got a lot of data to get through.
Yeah, and also it seems like investors are really trying to make sense of what to do with this data. Really eager to hear from Eddie Perkin, Chief Equity Investment Officer for Equity at Eaton Vance. Eddie joining us this afternoon on the phone from Boston. Eddie, how are you?
I'm well. How are you guys?
We're doing pretty well. Trying to really dig into today's trade and understand, what these CPI numbers mean for what the Fed's going to do. So, give us your take here.
We continue to have high inflation. I think there are multiple sources of that inflation. Part of it is all the money and the QE and the low interest rates that we've had for the past several years. That's the part that the Fed can address with higher interest rates. But there are a lot of other things going on causing high prices. Of course, everything happening in the energy complex globally. And I think this is the part that gets underreported is output or productivity is just not very good right now. You see that. So it's a supply problem in part. You see it across the economy. I mean, look at all the 10,000 flights being canceled by British Airways at Heathrow Airport. Any of us who go into restaurants, there's certain items on the menu that are not available. The hold times when you call a call center are lengthy, sometimes up to 2 hours. All the supply chain issues we've been discussing, those problems are not solved with higher interest rates. In fact, they might even be hampered with higher cost of capital. So I think part of the solution to inflation has to come from just working out these bottlenecks in the economy and getting productivity back up.
All right, just want to mention a headline crossing. He was nominated back in April by President Biden. We now have the U.S. Senate confirming Michael Barr as the Fed's chief banking supervisor. So again, this is actually, I think the vice chair of supervision. So again, that's just crossing the Bloomberg terminal. All right, so Eddie, when you look at this market and the equity universe, I mean, a lot of names have really been beaten down here. But do you think, based on the uncertainty with the economic outlook, that beating makes sense?
Some of it does, and the big debate is, if a recession is coming, how much of that is priced in? I don't think a deep recession is priced in, but I think some moderate downturn in the economy or recession is now reflected in certain security prices. The areas that I'm most interested in at Eaton Vance for our value portfolios are housing-related stocks, certain parts of the energy complex that still look interesting, certain financial stocks that look interesting. So there are, kind of more cyclical, housing-exposed, consumer-exposed parts of the economy that are really beaten up and were not super expensive on the front end. So they haven't gone from expensive to fair price. They've gone from fair price to underpriced, in my opinion.
Okay, so remind me, you said housing stocks, and what were the two other sectors?
I think anything related to housing. I think energy, particularly. Talking to my
energy. You think there's still room for energy?
Well, you've seen a pullback now, right? You had a nice rally at the beginning of the year, but the services stocks, because you're going to need multi-year investment to get, so again, back to the supply question, to get supply globally back into the world economy, you're going to need the capital spending and services stocks. So that's where we're seeing some value after this pullback we've seen in the commodities, and then certain financial stocks. And a fourth category would be some of the industrial stocks. That's where you get some better quality businesses that are more cyclical. And again, at Eaton Vance in our value portfolios, that's where we're finding value.
Bank of America economists are forecasting a mild recession this year in the United States, and they say services spending slowing, hot inflation bringing consumers to pull back a bit. Mild recession, would that bother you in terms of maybe some of your equity choices?
Not really. I think that's what the market is priced for at this point. I think you've got a stress test around that. That's sort of probably the central forecast of most investors at this point. So, what if it turns out better than that? What if it turns out worse? How much of a range around those scenarios is there in terms of where stocks are priced?
Okay, kind of a play on that. I ask everybody this: is the worst behind us?
Not the worst, but a pretty bad scenario, I think, is the worst of the pullback behind us?
Yeah.
For most scenarios, I think yes. That doesn't mean there's not further downside. I do take note of the fact that sentiment continues to be negative, and it's not just fear. It's people, I think, some of the hedge funds pressing their shorts, being quite confident in their underweights, and a lot of it is around earnings and the expectation that earnings estimates need to be cut. And who doesn't know that at this point? We all know that earnings estimates across the market are too high, and that beginning tomorrow with Jamie Dimon at J.P. Morgan and their earnings report, we're going to hear from the banks, and then we're going to hear from other companies in other sectors, and in general, we're going to hear that earnings need to come down. But a lot of that is in the price. So what I'm interested in is those companies that, when they give guidance, can reset the bar to a level that the market believes. And in those cases, you might see earnings guidance cuts and stocks rallying on the back of it. I think it's important to remember that stock prices generally bottom before earnings do. And so you got to be anticipatory and forward-looking.
Eddie, what kind of flows are coming in at this point? New money to invest.
Pardon, I missed the first part of your question.
What kind of money is coming in from investors, new money to put to work? Or is there more money going out right now and being parked in cash?
Yeah, I don't think retail investors have given up on the market, so you do still see flows in pockets of the equity market. I think there are those who are very committed to the long-term secular growth of technology stocks, and then you have those who are interested in the rotation that we've seen this year in the first 6 months of this year from growth to value stocks. And so there are definitely investors who are continuing to nibble at value and see see value as a multi-year trend. You know, we've had a multi-year period of growth stocks outperforming value.
Yeah.
Could we now be at the very forefront of a value market that lasts for several years?
Well, I've heard that before. And then I also heard this week, yeah, maybe growth is kind of interesting. That's where we want to go. If you had to pick value over growth right now, is value your play? Just quickly.
I'm a value investor at heart, so I'm biased, but yes, absolutely.
All right, we're going to leave it there. Hey, Eddie, thank you so much. Eddie Perkin, he's Chief Equity Investment Officer for Equity over at Eaton Vance, joining us on this Wednesday on the phone from Boston. All right, we just have a few minutes, just about 3.5 minutes left in today's trading session. We have bounced around. We're definitely off our lows of the session and the nervousness we saw earlier right after that CPI print this morning. In fact, we've got a slight gain on the NASDAQ. Call it 7 points, but call it pretty much flat. A little bit lower, call it flat on the S&P, and we've got the Dow just down about 0.5%. All right, it is time to head over to our TV colleagues for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and YouTube. We are counting you down to the close on this Wednesday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And we are about 2 minutes away from the end of the trading day. Caroline Hyde, Taylor Riggs, Katie Greifeld counting you down to the closing bell, and here to take us beyond that bell, it is our global simulcast. Carol Massa, Tim Stenovic, bringing together our Bloomberg TV, radio, and YouTube audiences as we do day in, day out to digest what is another extraordinary set of inflation data and, well, pretty muted moves in the stock market on reaction.
I love that you say digest because I feel like it's indigestion because it feels like investors are just not quite sure what to do with what was an incredibly hot inflation print. We knew it was going to be hot, but hotter than we expected. I'm surprised to see the equity markets. Not big moves here, Tim, but they're definitely off their lows today.
Yeah, not knowing what to do is a really good way to describe it. We saw the S&P 500 move between gains and losses more than 20 times today, so really searching for direction here.
Searching for direction, but some industry groups we know feel the pain, the financials, of course. Once again, at what point do we get a breather? At what point does the yield curve stop signaling a recession? We're so deeply inverted at the moment.
It's a great question. And I mean, the depth of this inversion is a really interesting one because I remember when we were back here in April when the yield curve initially inverted, everyone said it's all about the depth, the duration. Now we're starting to get some of those big size and scopes.
It's really interesting, too. David Sowerby, of course, from Ancora Advisors, joining us just about 30 minutes ago when he said the lack of reaction in the equity markets today in the face of that huge CPI print, Carol, shows that actually maybe the markets are starting to find a bottom. If they hadn't, you might have seen some much bigger moves here in reaction to 75, 100 basis points. So that actually also could be a signal that we'll look for.
Yeah, I agree with David. I was, driving in the car when I heard the inflation print. I thought, oh my God, inflation, really hot. I thought everything was going to, just sell off in terms of the downside when it comes to the equity trade.
And indeed, the equity markets take a little bit of a breather here. As we can see, you have an S&P. We'll start there off about 18 points, about 0.5%. Dow Jones, we'll quote that just for Remain. You're off about 200 points, 0.7%. And NASDAQ, that's actually the relative outperformer. It's still lower by about 1 to 0.2%, but lower on the session. And a Russell 2000 as well. Some calmness here as you think about, Carol, the strengthening of this dollar.
Yeah, and while you say there's calmness, it's interesting. I love when we dig into the internals. You're going to get into some of the major industry groups. But if you look at the S&P 500, most names in that index were lower today. 348 to be exact, Katie. 154 higher, 1 unchanged, but more negativity to the downside when you look at those large caps.
And you see that, too, if you look at the sector level, at some of those industry groups. Up the top, you do have some green. You have autos, for example. A lot of that is Tesla. You also have retailing and semis, chips getting a little bit of a bid here, but it is mostly red. Again, if you break the big benchmarks into sectors, and you can see banks at the bottom, Tim, that's just for you, off more than 1%, really dragging as we see bonds catch a bid and we see that yield curve invert, Carol.
All right, let's talk about some of the gainers in today's session, and they're somewhat connected. Twitter rallying, it was top in the S&P 500, a gain of about just under 8%, so near its highs of the day. Late yesterday after the close, the news, Twitter coming out, they're suing Elon Musk saying, you got to get this deal done. That $44 billion buyout of Twitter specifically. There was another related story, Hindenburg Research coming out and saying it has accumulated a significant long position in shares of Twitter, so maybe some support there as well. Tesla then, obviously related. Tesla shares, I thought it was interesting that they too were up 1.7% in today's session. We saw them top in the S&P 500, the NASDAQ 100. Keep in mind, 1 week from today, we will be talking about Tesla earnings. And then one more for you. It's a small cap name. About 20% of the outstanding float is being shorted. We're talking about Stitch Fix. SFIX is the ticker. Stock up about 13.6%, well off its highs, but nonetheless a big rally. A board member, Bill Gurley, buying about 5.43 million shares. Stock still down roughly 68, 70% so far this year, Tim.
All right, you got the gainers, Carol. I'm going to go with the decliners here. We're seeing Delta shares finishing lower on the day today. Earnings season, it is taking off, but Delta falling short when it comes to those profit expectations in the second quarter. The company also said those high operating costs are going to persist throughout the rest of the year. Remember, they are trying to reduce the disruption for customers, so they are reducing those flight delays to an attempt to extend capacity constraints. That's going to actually set the company back from an operational standpoint. Speaking of that, did you guys see the story that Delta sent an empty plane to pick up luggage?
Yeah, Caroline's luggage is still over there.
Oh, Caroline, I hope it gets back there.
That is why Heathrow is having to curtail the amount of people in it.
Well, better than sending it by ship, I guess you could say. Caroline, you hit on this one earlier, Fast Now. Always we get it early in earnings season. It gives us an idea of what industry is, what's happening when it comes to industry, down 6.4% today. The company's CEO said in an earnings presentation today, quote, demand remained generally healthy, but there were certain signs of softening that emerged in May and June. It really reminds me of the anecdotal stuff we got from the Beige Book a little earlier today. You could sort of swap those and it would be very similar. And then Canoo, this is a really interesting one, finishing the day down by 1.6%.
Romain loves this stock.
The Canoo, EV Go, or Go EV, I mean. It's got a great ticker right here. It was higher yesterday by more than 50% after it won an order for 4,500 vans from Walmart. But we learned today in a filing that the deal has some strings attached to it. It's got this provision that prevents sales to the rival Amazon. So we saw a little bit of a decline there today.
Oh, the tit for tat that goes on in the world of EV. Meanwhile, I tell you really what was such a dramatic move coming from not the Federal Reserve, but a different central bank today, that really actually upended the travel of the US dollar. And I'm looking at the Canadian dollar. For our radio audience, I'm looking at global macro movers, and the loonie, as people like to call it, but overall Canadian dollar strengthening 0.4% because the Bank of Canada went and shock and awe, 100 basis point move in terms of increasing its rates. No wonder we're already seeing that being talked about here in the United States as well on the back of that very hot CPI print. But this isn't only an inflationary story here in the US, it is worldwide, and that is why we're seeing actually a slight weakening in the dollar index. So says a lot of the reporting out there. In fact, the Japanese yen has been weakening against the US dollar as well. Maybe no flight to haven there that's happening at the moment, but we know the weakness that the yen has shown throughout of the year. I'm afraid the euro isn't on here, but it did get to parity at one point today, and of course that's after a 12% decline so far in the euro versus the US dollar. So clearly worrying about the European overall economy, and that is, of course, as they face very high energy prices. I'm looking actually here in the US at a story of oil not trying to find a direction on the day. It did end up settling higher, but we see natural gas pushing higher, up more than 7%. That has been a key European story as well, with gas pushing up higher in Europe. Here in the US, once again, weather getting hotter. We're turning on our air conditioning, gas pushes on the upside. Iron ore just pulled back a little bit as we worry about how far the Federal Reserve will indeed move and what that may mean in terms of recession. It was interesting that gold got a bid as finally we start to worry about recession as well. And sovereign bonds, very mixed picture, but overall we saw actually yields push higher in Europe, Taylor.
Interesting that a little bit of that flatness of the yield curve, Caroline. When you think about yields higher, that certainly is the case on the front end of the yield curve. As we've talked a lot about 75, do we go 100 in just a few weeks? You have a 2-year that climbs 8 basis points of the day, near sort of the highs of the session that we got immediate reaction after 8:30 a.m. this morning to a 313. Everywhere else, though, Katie, was sort of the flatness, right? Buying coming into this. And we get very sort of active, engaged watchers on this program. And I get a comment here. The markets have shifted from inflation to recession. We're headed to disinflation, likely a recession. The dollar is onto this. The bond market for sure is onto this. And I wonder if that's the signal from that inverted yield curve that deepens.
Yeah, I mean, if you look at the dynamic of what's actually driving the inversion today, I think that makes a lot of sense, that it's actually the front end selling off, but everything else catching a bid that tells you the Fed is going to hike and growth is going to fall. It's actually a really poetic sort of picture there.
I don't know if you guys saw this on the MLive blog. Ed Harrison, our senior editor in our Washington, D.C. bureau, said, high inflation could force the Fed to actually hike during a recession. We got this in 1980. We've also saw that in 1974. So think about it. If inflation continues to stay high and yet we fall into a recession, could we see the Fed continue to be aggressive? And what kind of problems does that create for the economy overall?
Well, speaking of aggressive, I was a little surprised to see the lack of equity market reaction or muted equity market reaction when we started talking about 100 basis points, like we were talking about 75 basis points 3 weeks ago.
Yeah, I mean, it dipped into the red at that particular moment and then sort of after that took it in its stride overall. I wonder whether or not, as guests have started to say, we're sort of factoring in a very aggressive Federal Reserve. We're taking it a step forward instead. We're looking at indeed where we go in terms of a recession. I think also the data is going to be coming thick and fast. We're going to get the micro data of earnings. We've also got retail sales coming on Friday. What therefore is the consumer doing is oil does indeed, of course, take so much more of their pricing away from them in terms of their wallet. And what that means for July, because we are expecting it to roll over. You also get what business sentiment is going to be like on Friday with the Empire Fed. So all of these little bits of scraps of data really going to feed into what we anticipate the Fed to do at the end of the month.
Loving the corporate angle of that. I mentioned David Sowerby over at Encore Advisors saying that if you actually look at the micro, the companies are okay. Now, of course, no company can handle 9% inflation, but Home Depot, as he mentioned, been around since the 70s. If anyone can handle inflation, they can. So when you start to think about the health of these balance sheets, the way these companies are able to navigate, are we maybe being more pessimistic than maybe some of the CEOs?
He also made the great point that actually there's still pricing power to be had for a lot of these companies. They still can raise their costs onto a consumer where their balance sheets, their household balance sheets, still look pretty good. I mean, it's going to be a really interesting conversation over the next few weeks as we start to hear that C-suite commentary.
Watch those household balance sheets, because that has carried us through so much. If they start to come undone and the consumers stop spending, that could be certainly a problem for the overall economy. All right, we got to wrap. Tomorrow we'll be talking big time, those big bank earnings, JP Morgan at 7 a.m. Wall Street time. We will catch you, though, for another cross-platform coverage, radio, TV, YouTube, Beyond the Bell, same time, same place, tomorrow.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's going to be busy. We've got JP Morgan Chase, we've got PPI tomorrow, we've got weekly jobless, and then we're going to get another bunch of economic news on Friday and some more bank earnings.
Sentiment numbers.
Yeah,
right?
Which is what Michael McKee, like at the top of the week, kicking off for us and saying, yep, we all are focused on CPI, and rightfully so. It was a big number, but he's like, sentiment is something we really want to see, because if consumers start to be worried, I won't have a job, I don't have as much money in my pocket, I'm not going to start doing things, or I'm going to stop doing things.
All right, all that data coming later this week. First, though, a check of world and national news. For that, we go to Nancy Lyons in Washington, D.C. Hey, Nance.
Thanks, Tim. Today, President Biden opened his first visit to the Mideast as president by pledging to strengthen ties with Israel.
The connection between the Israeli people and the American people is bone deep. It's bone deep.
Later in the week, Biden will meet Saudi Arabia's Crown Prince Mohammed bin Salman. The president hopes to secure a boost in oil production to help ease U.S. gas prices. With another recess just around the corner, Democrats plan to skip the markup sessions and go straight to posting spending bills before leaving town.
Lawmakers still have not been able to come up with a bipartisan agreement to set those top-line spending numbers. Plus, Appropriations Chair Patrick Leahy is out after he broke his hip last month. So they're dropping plans to mark up the spending bills this summer. Senate Majority Whip Dick Durbin tells Bloomberg Government the Appropriations Committee is expected to post the bills online ahead of a post-election lame duck session. The Senate's next recess is August 8th. In Washington, I'm Amy Morris, Bloomberg Radio.
Today is an official day of mourning in Akron, Ohio for Jayland Walker, the unarmed black man shot and killed by police last month. And during Walker's memorial today, Pastor Marlon Walker said our system isn't working.
The tragic killing of Jayland Walker underscores how deeply dysfunctional and discriminatory America's system of policing continues to be.
Pastor Walker says we need to reimagine policing. The officers involved in Walker's death are on paid administrative leave pending the outcome of the investigation being led by the Ohio Bureau of Criminal Investigation. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. Nancy Lyons in our Washington, D.C. newsroom. We're going to talk a little bit more about Tesla and Twitter in particular in just a moment. In the meantime, we did talk about Twitter shares. They rallied today. Tesla shares also gaining in what was kind of a mellow, muted market by the close today. Meantime, Elon Musk, another legal battle.
Yeah, Dana Hull, who covers Elon Musk and Tesla so closely here at Bloomberg, has a new story out that said that Tesla bulls who rejoiced last week and Elon Musk sought to terminate his agreement to buy Twitter. Now they might see that initial relief giving way to the realization that the overhang from this ordeal is not going to lift, Carol, anytime soon.
Yeah, I mean,
he's a busy guy.
Well, anytime we cover a story where there's a legal overhang, that tends to depress a share price. We often see it. And then when it gets cleared up, even if there's a settlement or what have you, investors are like, done. You know what I mean? And they can move on. And then you tend to see a stock rally.
Not with this guy.
But this is another, overhang. Fears that Tesla's CEO would have to sell a chunk of his holdings in the car maker to partially fund the Twitter purchase also were quickly realized when Musk offloaded about $8.5 billion worth of Tesla stock. I mean, there's so many different moving parts to this. And I think for investors, they're just trying to assess, okay, what will ultimately be the impact on Elon as a leader of many different companies in different areas, and what will be the impact on Tesla specifically.
A very busy dad, too, right?
Busy dad.
Okay, so assuming that Musk and Twitter are unable to agree to an out-of-court settlement in the meantime, the lawsuit that the latter filed on Tuesday will take time to work its way through the Delaware Chancery Court. That's Twitter, I should say. Twitter did tell staff in a memo Wednesday that it's asked for the case to be heard on an expedited basis in September. You know what? And I think a good part of this conversation, Carol, is what does this mean for Twitter employees who are in limbo right now? And they have been for quite a long time. We've had a lot of reporting from our team out in Silicon Valley about rescinded offers and people who actually accepted jobs at Twitter saying, then they get the news that, they can't work there as a result of, what's been happening.
It's very tricky, right? Nobody likes uncertainty internally, externally. And so nonetheless, it looks like a court battle of some sorts is looming. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. U.S. rate markets turned sharply today as investors rapidly shifted focus from the prospect of inflation-taming interest rate hikes to the potential economic damage such tightening might inflict. Today, we saw the 10-year yield at 2.91%, but the 2-year yield 3.13%. Equities lower across the board after that hot CPI report this morning. S&P down 17 today, drop there of 0.5%. Dow Industrials down 208, drop there of 0.7%. Nasdaq down 17, drop there of just about 0.15%. Keep in mind that at the worst level of the day, we did have the S&P down 1.6%. Again, to be clear, ended the day down by 0.5%. 10-year worth repeating 2.91%, repeating the 2-year 3.13%. Spot gold up 0.4%, $17.33 the ounce, while West Texas Intermediate crude today up 0.2%, $96.01 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. Appreciate that update. You are listening to Bloomberg Business Week on this Wednesday. So certainly one of the big business stories, it kind of broke late last night, was about Twitter suing to force Elon Musk to get his $44 billion or $54.20 a share buyout of Twitter. Just get it done. And we've talked about Twitter rallying today, and even Tesla was up in today's session.
Let's get into it with Sarah Fryer. She's big tech team leader for Bloomberg News. She's also the author of No Filter, the inside story of Instagram. Sarah joins us this afternoon via Zoom from San Francisco. So Sarah, why is Twitter actually in a strong negotiating position right now with its protracted legal battle with Elon Musk?
Well, the legal filing revealed that Twitter actually had the means to ask for a lot of concessions from Elon Musk, that they made the deal rather seller friendly. So what that means is Elon Musk was in such a rush to get this $44 billion deal done, even making threats to Twitter saying, if we don't do this deal right now, I'm going to sell my stake in Twitter, which would be very bad for you. And so as they rushed to the negotiating table, Twitter was able to ask for things such as the right to hire and fire employees as they please, the right for anything that is already in their Securities and Exchange filings to not be considered what's called a materially adverse effect, anything that could be discovered that could make the deal off. And of course, Elon Musk has been using both of those things, the fact that Twitter made personnel changes and the fact that Twitter has a bit of a bot problem, as reasons to now pull out of the deal. So this legal filing yesterday was really Twitter saying, don't forget the contract you signed. It's pretty ironclad for us. And you're not operating in good faith because you know all of these things. And that's really the takeaway here. They just outlined over and over how they have tried to comply with Elon Musk's wishes and whims, and how he has either not taken that stuff to heart or gone afoul of the deal terms.
I feel like it'll ultimately, Sarah, come down to MAE, material adverse effect, right? The buyer could only back out of the agreement in the case of a material adverse effect. And I feel like this is what they're going to spend so much time in the courts about, or the lawyers are going to be talking about.
Yeah, absolutely. And that term is very narrowly defined according to Twitter. It can't be anything to do with the markets. The market fall since Elon Musk made his deal for Twitter, that's on him, according to their agreement. It can't be anything to do with, changes in Twitter's perception in society. There are a lot of things that they managed to negotiate into the deal to make it seller friendly. And in fact, Elon Musk said that he wanted to have a relatively seller-friendly deal, and some of those concessions are coming back to bite him now.
Okay, so we're trying to get a good idea, and I don't want to make you predict things because we can't predict, especially when it comes to anything related to Elon Musk. But I do wonder about the repercussions here, and I mentioned, Sarah, that you and your team have done some reporting around what this means inside Twitter and the way that this is kind of dragged on publicly, but also privately at Twitter, and we've learned about the effect that it has on employees there. And I'm wondering how, what's going on inside Twitter right now as a result of this back and forth.
Nothing good.
Yeah.
I mean, listen, Elon Musk is going to come out of this fine. He's richest man in the world. Banks are going to work with him again. Lawyers are going to work with him again. They need to, because he's going to be in all sorts of major IPOs and acquisitions down the line. Money is going to move, and it's going to be an opportunity for those folks, even if they've been burned in this situation. For Twitter, though, this is not a good situation. Look, they have said in the filing themselves that Elon Musk has contributed to an irreparable harm to their business, a decline in shareholder value. They're not going to be able to, on their own, easily get back up to that $54.20 a share. So they feel like they need this deal for their shareholders. It looks a lot better than how the stock is trading now. That said, they just went 60 plus pages describing Musk essentially as a liar, someone who's operating in bad faith, somebody who ghosted on them, ignored their data that they handed over on bots, all sorts of negative things that they said about this guy, and yet they still want him to own their company. He's harassed their employees. He's brought the whole staff
like a
through
prenup
a lot of
going really bad, and then you still have to go down the altar.
It's just, right. It's either going to be a situation where this drags on and the uncertainty worsens and you lose a lot of people. It's hard to hire. It's hard to make progress at Twitter. Or, Elon Musk does come and join the company and he's a reluctant owner. He doesn't actually want to own this thing. So, is he really going to be a good steward of the future of the business?
That's what I find so remarkable about this back and forth, Sarah, is that at that point where they invited Elon Musk to address the team at Twitter, and then there was the point where where before that, but the back and forth was happening on the actual platform, and then you have this happening where publicly now the company, the individuals and the people involved with the company are going after each other. So which is it?
Excuse me there. Yeah, I think that on the one hand, you have the fiduciary duty. You need to do this for your shareholders. On the other hand, you're more than just a fiduciary when you're dealing with a product like Twitter, which has such an outsized societal impact. It has all the major power brokers in the world. It helped people like Donald Trump ascend to the presidency. This is a really powerful platform.
Right.
And you're not just thinking about the shareholders here. You're thinking about the employees, but also the users and the politics and everything that goes beyond that.
I really don't know how it's going to play out, but I can't help but feel that Elon's a very smart man and knew what he was doing and rushed through, and I don't know how the courts are going to kind of read all of this. Sarah Friar, thank you so much. Big tech team leader at Bloomberg News, author of No Filter, the inside story of Instagram, joining us via Zoom from San Francisco. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yes, indeed. This is Bloomberg Business Week. On this Wednesday, we talked with the CEO of Saks, the e-commerce site that was spun off from Saks.
And I had a supply chain question.
We did. And we talked about our next guest is actually the Chief Supply Chain Officer over at American Eagle, so we're going to get to him in just a moment, see what his life has been over the last couple of years.
Yeah, I bet it's been pretty exciting, stressful. We're going to get to that in just a minute. First, though, Charlie Pellett, give us an update on things happening after the market close.
Indeed, we had a down day today for the Dow, the S&P, NASDAQ. At one point, we did have the S&P down 60 points, lower by 1.6%. Ended the day with the S&P down 17, drop there of 0.5%. The Dow today down 208, down 0.7%. NASDAQ lower by 17, drop there of 0.1%. 10-year big story, the yield curve remains inverted with a 10-year yield of 2.92%. The 2-year right now, 3.14%. Spot gold up $8 the ounce, 17.34, a gain of 0.5%. West Texas Intermediate crude oil today up 0.3%, 96.17 for a barrel of West Texas Intermediate crude. CPI Wednesday, stocks whipsawed as a shockingly hot inflation report rattled global financial markets, boosting bets the Fed could get even more aggressive with its belt-tightening campaign. Well, as for the market backdrop and the outlook for earnings, Eddie Perkin is Chief Investment Officer for Equity at Eaton Vance. He was our guest right here on Bloomberg Business Week, and he told us he's looking ahead to tomorrow's earnings and says estimates will be coming down.
We're going to hear from the banks, and then we're going to hear from other companies in other sectors. And in general, we're going to hear that earnings need to come down. But a lot of that is in the price. So what I'm interested in is those companies that, when they give guidance, can reset the bar to a level that the market believes. And in those cases, you might see earnings guidance cuts and stocks rallying on the back of it.
And speaking of earnings, J.P. Morgan Chase very closely watched tomorrow. JPM down today by 0.9%. Also hearing from Morgan Stanley, shares down 1.3%. Financials lower today. Citigroup reports Friday down 1.4%. Wells Fargo also Friday down today by 1.3%. So again, recapping, down day on Wall Street, CPI Wednesday with the S&P dropping 17, down by about 0.5%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, we are talking a lot about retail today, an area that went through a lot of disruption, innovation during the pandemic, e-commerce reigning supreme. And retail, though we know, Tim, continues to be faced with so many questions when it comes to consumer demand, stresses over supply chains. Not easy being a retailer.
No, it's not. We've got a great voice on this. In the studio with us, too, Shekhar Natarajan, Executive Vice President and Chief Supply Chain Officer for American Eagle. He's with us in the Bloomberg Interactive Broker Studio. Shekhar, great to have you with us. How are you?
Thank you. It's an honor to be here.
Well, it's funny because Carol and I were talking just a couple of minutes ago, and we were thinking, okay, what have the last 2.5 years been like for you?
Piece of cake.
Yeah, for sure. Well, chaotic to say the least. But as American Eagle, we are also very optimistic about the future because we are...
Wait. We're not going to let you talk about the future yet. So you joined American Eagle in 2019, so before the pandemic, right? So you just got yourself settled, got everything set up, and then the pandemic hits.
Yes.
Walk us through, because it's really been telling and I think informative, like what we've learned from companies about the pandemic and maybe how that impacted strategy for you guys.
Yeah. Even before pandemic hit us, we started envisioning the future of the supply chain, how it's going to look very different. And so if you look at where there was a lot of cost escalation in doing business, it was really from what I call the middle mile, the time the product enters into the country to the time it actually gets to the doorstep. And that was the fastest growing expense that we saw. And it's across the board. Like every industry, every retailer says that the shipping expenses are actually
transportation?
Transportation expenses. They were not leveraged. And so we wanted to change the game. And we started thinking about what would the disruption look like, because we wanted to disrupt ourselves before the industry disrupts us. right? So we started laying out a strategy, and that strategy was all about getting the inventory closer to the end consumption point and doing it in an omni-channel fashion so that you could maximize the value of the inventory, reduce the transportation cost and the miles traveled.
Hold on, how do you get the inventory closer to the place of consumption, especially when this stuff is created half a world away?
Yes. So what we're talking about is once it actually comes into the country, the time basically, like, let's take an example, right? Like, if a pair of American Eagle jeans was actually sold in a store, it would be sold on a Sunday, read on a Monday. The allocations would happen on a Wednesday. Like, you would actually pick pack on a Thursday. It would show up, like, the trucks would leave on the following Monday. It would show up in the customers in the stores like 2 weeks later, pretty much. And so the time it takes was about like 14 days, the worst case scenario. And so what we wanted to do is, how do we get to daily replenishment of the stores? And also, like, you know, when you allocate it, the product in the store is like literally like 2.5 days away. Right. So that that compression of the time was what we were trying to aim for.
Right.
And so what we did is basically we created a lot of decentralized locations. Instead of shipping from halfway across the country, we started putting distribution centers closer to where people live, started holding the inventory
Is
there.
it like the Amazon model in terms of regional distribution?
Absolutely like the Amazon model. And when we presented this, people thought I was crazy because it works for, like, you know, diapers and soda, not necessarily for fashion, because fashion changes pretty fast. And so what we had to do was really power our systems with a lot of advanced, like, thinking from AI. Perspective, and that drove the inventory decisioning and the sciences associated with it, which really helped us, like, transform the business.
So basically, if all of a sudden Tim's really into yoga pants, and they're like, you know, he lives in New York, you get kind of a spike there, or, you know, and others, right? And the data says we got to get more yoga pants to New York.
Yes.
It's as simple as that.
It's as simple as that. And, like, you know, creating a responsive supply chain. And when the pandemic hit us, it was also a rude awakening that, like, you know, the distribution centers were very fragile. Like, you know, we have 2 distribution centers, one in Ottawa and one in Hazleton, and the population was, you know, was affected there. And so we were at the risk of actually, like, shutting down the business, because if those 2 facilities go down and the stores are not available, then you run the risk of actually not having any of these operations at all.
You don't have the flexibility to move to something like 1, 2, that's it.
That's exactly the point.
So even the increased overhead, we've only got about 30 seconds and we'll come back and talk some more, but even the increased overhead of having more logistics centers, that makes up for it by having them closer to where the demand is.
Yeah, so what...
Just quickly, and then we'll come back.
Yes, what we did is actually address that increased overhead. So we went into a sharing model. Instead of us owning the facilities, we started, like, doing that with like 50 other brands.
Right.
And that helped us, like, actually make the supply chain much more variabilized.
All right, we're going to continue with this, because this is really like getting into the nuts and bolts of these supply chains and how it works.
Yeah, we're talking to Shekhar Natarajan, Executive Vice President and Chief Supply Chain Officer at American Eagle. More in just a few minutes. First, though, a check of latest world and national news with Nancy Lyons in D.C. Hey, Nance.
Thanks, Tim. President Biden is in Israel. It's the start of a 4-day trip to the Middle East. He says America's relationship with Israel is the strongest it's ever been.
May Israel and the United States continue to grow and prosper together for the benefit of the entire world.
Biden has also weighed in on the latest report on inflation, showing the consumer price index up 9.1% from a year ago. That's the highest it's been since the end of 1981. Biden calls the report out of date, since gas prices are now declining. Democratic-controlled cities in Republican-led states are looking for workarounds now that the Supreme Court has overturned abortion rights.
Prosecutors from Atlanta to Indianapolis and Charlotte, North Carolina have all said they won't file charges against medical workers who provide abortions or their patients. New Orleans is one of the first cities to tell police not to investigate abortion cases. In all, the Washington Post reports more than 50 district attorneys across the South and Midwest have signed a pledge not to prosecute cases involving abortions. And later this month, the city council in Austin, Texas will vote on a resolution instructing their police department to make abortion their lowest priority. In Washington, I'm Nathan Hager, Bloomberg Radio.
Americans appear to be losing faith in democracy. The New York Times Siena poll finds 58% of voters feel the current system needs major reforms or a complete overhaul. For Republicans, they're worried about the legitimacy of elections, while Democrats say even with control of the White House and Congress, the system and Republicans prevent them from achieving their goals. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, thank you so much, Nancy Lyons. We are talking with our guest, Shekhar Natarajan. He is Executive Vice President, Chief Supply Chain Officer at American Eagle. We're going to talk for a couple of minutes and then bring him back and do some more. But take us back to March of 2020. Tell me how stressed were you guys? What were the discussions you were all having in the C-suite? Because I feel like the financial crisis made CFOs crucial, right? Because they financially kept companies alive. The pandemic, I felt like it made HR and supply chain people so important in getting companies through.
Yes. So for the first, I think for all companies, they started realizing the importance of supply chain thanks to COVID, right? Primarily because that became the heartbeat of everything which was happening. Everything was centered around how do we think about labor availability, safety of the associates, making sure that product is available. And when COVID happened, everything shut down from a store distribution perspective. E-commerce was the only way people could consume, and distribution centers were the only arm which could actually service the customers, right? And so it was very, very stressful. It was very painful, in fact, to actually furlough some of our store associates, and continue to have these operations. And we were always talking to the state executives and basically the county officials saying, why are we basically an essential business? Why do we need to keep running this? And the safety protocols we put in. The first thing we did, Nancy, and we're super proud about what we're trying to do, what we did, is we put safety ahead of everything else. We bought state-of-art equipment in our distribution centers. Right. We had nurses on duty. We had doctors on duty. We were following all of the CDC guidelines just to make sure that the distribution centers were operating. But at the same time, when you have a disaster of sorts, you focus on what is most relevant, right? Which was creating this distributed model.
Yeah, it's really fascinating. We're going to continue talking about it because I love how you guys were tackling really in terms of the supply chain ahead of the pandemic and how it's held over. We're going to come back to Shekhar Natarajan of American Eagle. This is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Twitter's lawsuit to force Elon Musk to follow through on a $44 billion purchase of the social media platform will be handled by the chief judge of Delaware Chancery Court. Stocks move lower today. Stocks were whipsawed as that shockingly hot inflation report rattled global financial markets. Boosting bets the Fed could get even more aggressive with its belt-tightening campaign. Today, we saw the S&P 500 index fall 17 points, down 0.5%. The Dow down 208, drop of 0.7. NASDAQ down 17, a decline of 0.1%. The 10-year yield, 2.93%. The 2-year yield, 3.14%. Spot gold up 0.4%, $17.33 the ounce. And West Texas Intermediate crude up 0.4%, $96.26 a barrel on WTI. Recapping, S&P down 17 to 38.01, a drop today of 0.5%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, so appreciate it. Thank you so much. Charlie Pellet with the Bloomberg Business News Flash. We do want to get back to our guest. Shekhar Natarajan is with us, Executive Vice President, Chief Supply Chain Officer at American Eagle. I got to say, the conversations we're having, it's so great to have him.
Never turn the mics off, okay? Well, no, we'll talk. We'll continue to have our good chat. It's okay.
Yeah, exactly. So talk to us more about, as you said, you guys are doing more distribution centers, more closer to where people are buying, and that's changing. How much of that has to do with carbon footprint?
Well, it has everything to do with regenerative networks, because I think, like, people talk about sustainability. Sustainability just acknowledges the fact that we have screwed up the world, right? And so we are saying that we want to be carbon neutral. But what we intend to do with this new model that we're building out is to create a regenerative business, which means that giving back to the society. So as an example—
How does it give back, though?
Example. So when we built out this distribution network that we did, American Eagle grew the business by 30%, right? But we reduced the number of parcels which are actually going to the doorstep by 17%.
So less stuff left.
It was less stuff,
because
instead of having stores do all of your shipments, we were consolidating them into fewer locations which could do the shipments, and so the number of packages which are ending up at the doorstep were much lesser than what it was, though the volume grew. The second thing, it actually reduced the number of miles, because you're that much closer to the end consumer. So we reduced the number of parcel miles by 2 billion miles.
That's a number. What percentage is that?
Well,
it sounds like a lot, but you know what I mean?
For us itself, it was about 10%.
Okay.
Right? And then let's take the cost of doing business, because we were sharing our network with other brands through the consolidation that we were creating. It's a sharing economy model. Right? So the cost was much lower. So we were able to deliver packages $1 cheaper and a day and a half faster. Right? So it's better for the planet. It's better for profits. It's better basically because you're tapping into the local economy, right? So it was better all the way around. And so we thought this is fundamentally a good business model that we should now begin to scale and democratize access for everyone. And that is the mission of this company. And just to give you some context, I come from, and I'm proud to say that on radio, that I come from slums in India, where access to funerals, paying for funerals or paying for education, paying for electricity was a big thing, and all we know is how to share. And supply chains is anything but going to be an abundant resource going forward. We don't have enough people.
Right.
If the number of parcels just doubled in the next 6 years, went from 20 billion parcels to 40 billion parcels, you would need to have 823 fulfillment centers, 5,000 distribution centers, 8,400 delivery hubs, 1 million trucks over the road, and about 750,000 delivery vans, which accounts to 16 million more people that need to get employed. And US is only growing at 300,000 a year.
Right.
So where do we find all that people? The price escalation is here to stay. from a supply chain perspective, right? And so the notion of sharing opens up capacity everywhere in the network.
So you're saying sharing with you and other companies, like why wouldn't we all just tap into it? And
exactly.
It becomes the business model. Tim, what?
We were talking robots yesterday.
That's what I was thinking of automation.
Yes. Yeah. And I'm wondering how you've automated parts of the supply chain or parts of logistics in order to make up for that loss of people that we've seen here, loss of employees.
Obviously, robotics is an augmentation to people's abilities to perform, right? And so, but that's not going to be the full answer. The answer lies, think about what would the world be if every company did the same thing that American Eagle did. American Eagle still has 2 massive distribution centers, 1 million square feet, one in Ottawa and one in Kansas City.
Right.
We run that facility at 70% utilization for 48 weeks in the year, right? We need the full capacity for 4 weeks. And so that's the case with every distribution center in every industrial park.
Right.
They're only built and designed for the peak. So if everyone started sharing, that 70% becomes 95%. So you reset the base of how you use these facilities, the people that you're using, and how you could efficiently run these supply chains.
So I'm assuming you guys at American Eagle are reaching out to others to say, come on board with this.
Yes.
Tell us about who you're talking with, what kind of interactions, and are people, is it small businesses that are saying yes, or is it larger companies that are saying, yeah, we want to partner with you?
Well, we are very, counter to what, people thought, we are proving that collaboration is already at play and is a revolution which is happening right now. So we've signed up 9 brands since we've acquired. So the total number of brands that we have on board is about 40 brands, but we have an extended partner network, about 70 partners on the network,
right,
providing all kinds of services, transportation services, warehousing services, and basically brands accessing all of that capacity today. And some of these brands include Fanatics, Steve Madden's, Saks.
We just talked to the Saks CEO.
Yeah. So. And a lot more brands to come. And some of these brands are actually competitive in nature.
Shager, we've only got about a couple of minutes left here, and then we've got to wrap up, unfortunately. But so Tim and I talk all the time about supply chains, and you know the story of the last year and a half or 2 years. It's just been really stressed supply chains. Are they easing?
It is easing in one place, which is inbound. The freight.
So more stuff's coming in.
The stuff coming in, basically, the spot market is it's no longer $20,000 a container. It's $7,500 a container.
It has gone down that much.
It has gone down that much. But a little bit of chink in the armor there is that a lot of people have actually contractually signed contracts with all of these ocean carriers at a fixed rate. Right, so now they are in a little bit of a pickle. Yeah, exactly. So how do you kind of manage that balance of using a spot market versus the contractually obligated volume? So I think that side of it is going to ease into the next year.
It's going to work its way through.
Yeah, but I think the biggest inflation is going to still come from the time it hits the country to the time basically it gets delivered to the doorstep.
Is that because of fuel? Just 30 seconds. Is that fuel? Is it employee cost? What is it?
It's the fuel, it's the employee cost, and also the growing demand of e-commerce. E-commerce is a full service model. You used to go to the store and basically pick up 50 items and come back. Now that basket is getting fragmented between 5 brands, and 50 boxes are showing up at your doorstep,
that is
and
not
20
efficient.
items.
Yeah.
That is not going anywhere.
And people are sending it back.
Yes.
They're returning. That's expensive.
Yeah,
I'm a
big I order a lot and then I return, and I like omni-channel where I can drop it at the store then to return, so I don't have to repackage it. Come back soon. This was really informative and smart. Shaker Natarajan, he is Executive Vice President, Chief Supply Chain Officer at American Eagle, worked at Target, worked at Walmart, worked at Disney. So next time we'll talk about that. A delight to have him. For Tim Stanovic and the whole Bloomberg Business Week team, I'm Carol Massar, and this is Bloomberg.